Special purpose acquisition companies came barreling into a bull market in 2020 to become one of the hottest trading trends out there. The fad attracted everyone from celebs to degens to Wall Street titans, making up over 50% of all the growth in the US IPO market for the year and raising over $80 billion in proceeds. Now though, headlines are filled with cancelled SPAC plans, decimated valuations, buyouts and bear markets. Analysts are running through the streets shouting, "The SPAC bubble has burst! The SPAC bubble has burst!" And you know what? They very well could be right. This quarter has seen a shocking 98% decline in the value of SPAC IPOs from the first quarter of 2021. Of the 64 SPAC mergers that closed in 2020, only 7 of those are currently trading at prices higher than what they opened trading at, and a growing number, at least 25, of the companies targeted by SPACs are now issuing going concern warnings. Of the 600 SPACs still frantically looking for targets before the market shuts down entirely, 270 have been looking for over a year. Everyone is basically looking around and thinking, what the hell happened here? Well, we've done the heavy lifting for you on that question, so let's take a look at what SPACs are, why they became popular, why they've collapsed, as well as 3 of these companies that have defied all odds to come out on top. You probably already know what an IPO is, an initial public offering, and they happen when a private company becomes public by selling its shares on a stock exchange. Well, SPACs, also known as blank check firms, basically go public without yet having any operating assets. Instead, their job is to raise money so that they're able to buy another separate private company, chosen at a later date, and then take it public using their empty vehicle. So I guess you could kind of say that buying businesses is their business. But their work is done once the shell of the SPAC is filled. Generally, a SPAC is formed by an experienced management team or some kind of sponsor/rich dude who considers themselves as having the business version of the Midas touch, and they're called sponsors here. So, SPAC investors will give money to a sponsor. Typically, it'll be $10 per share. That's kind of the standard buy-in price. And those shares will be traded on the stock market. The sponsor will be like, we're going to buy something super cool and you're going to make money. And a lot of the time they will get a massive influx of investment before even choosing a target to take public, sometimes billions of dollars. They'll take that money, they'll look around and they'll say to investors, that looks like a cool company, what do you think? And investors can either say no and take back their $10, or they can stay in the game, which they often do. The SPAC then gobbles up the private company and sets it free in the public market. But as a private company, why would you go down this route? 3 main reasons. Firstly, cost and accessibility. Public markets are not super accessible for companies that don't have substantial revenues, profits, and proven technologies. So SPACs became an appealing option because it costs less for them to go public. The underwriting fee for a SPAC IPO typically comes in at around 5.5%, quite a bit lower than the 7% that investment banks will charge in a standard IPO. Worth noting here that there are other risks involved. In a typical IPO, investors can't just take their money back, but in a SPAC they can. So if, for example, you go through the process of underwriting an IPO and then a bunch of your shareholders pull their cash, it could mean that the underwriting fee is greater than the amount the SPAC raises when it goes to market. Doesn't happen often, but it does happen. Second, speed. IPOs often require the senior management team to go on an IPO roadshow and pitch their story and potential to investors to drum up as much hype as they can because they need those buyers for a strong IPO. Not necessarily because it's legally required, but more because otherwise they run the risk of the company's shares trading lower than expected when they debut. The roadshow lets you get a gauge on analysts' and investors' sentiment and commitment, so you can be better assured that the price you want to list at will be achieved. It takes months and months and the full attention of execs, so if a company isn't so keen to go down the hard route, a SPAC is super helpful because they've already raised all the money on your behalf, and it's not as important to convince people to get involved. Lastly, certainty and control. Leading up to an IPO, there are always a lot of unanswered questions around what your valuation will be, what kind of liquidity you'll be left with, but with a SPAC, you already know exactly how much capital you'll get and how many shares will be bought. On top of that, SPACs allow business owners to maintain a significant stake in the company instead of giving up control to take on private equity or to sell shares in the business. These are at least some of the reasons why we saw a 462% year-over-year jump in proceeds related to SPACs from 2019 to 2020. SPACs literally made up over half of the companies that went public that year. We watched some of the most buzzy names hit the market, including a bunch of beloved EV and automation-related stocks like Nikola, Fisker, Lordstown Motors, popular entertainment companies like DraftKings and HOF Village, some cutting-edge pharma stocks, and a few fancy fintech brands like Paya Holdings. As with any new hot trend, there were some key trendsetters that started off the run on SPACs, one of the most important of which was Chamath Palihapitiya. This dude was so instrumental to the takeoff of this investment tool that people now call him the Pied Piper of SPACs, except with millions of little investors following his moves instead of little rats, so way less gross. Back in 2019, Chamath decided that SPACs would be his new adventure. He opened up his little black book to find the people who he knew had a little bit of moolah to throw around and pitched them his first SPAC, Virgin Galactic. He was a great leader for the voyage into SPAC land because the man is basically charming AF and people wanted to hear what he had to say, helping spark the SPAC movement in a big way. Other SPACs took that lesson and ran with it, and suddenly you had people from all industries getting in on the hype. The fact that the market was overrun with new, undistinguished SPACs and had so many companies competing for attention meant that a lot of sponsors lined up A-list and some B-list celeb names to serve as board members or backers, even if they couldn't bring a bunch of corporate experience with them. We saw the likes of Serena Williams, Martha Stewart, baseball star Alex Rodriguez, and his perfect at the time fiancée J-Lo, shout out to Bennifer, all backing or promoting a SPAC. Even Leonardo DiCaprio was getting involved, and seriously, who's going to say no to Leo? He has been through enough. What's more, if we look at the timeline here, we're also smack bang in the middle of COVID. IPO roadshows became pretty much impossible. The retail trader was born, and the market thrived as the virus slowed to kind of create this perfect storm of market liquidity and low interest rates, where people thought that they'd scored the motherlode of access to easy money. You see, SPACs attracted retail investors quite a bit because they were let into a club that was previously closed off to them. Historically, traditional IPOs had been off limits for retail traders because the first offering is saved for big investors like hedge funds or banks. SPACs, however, were free game once they went public, but no target company had been chosen. They couldn't believe it. SPACs were walking around like, please take our stock off our hands. It was like that episode from Oprah, you know the one. So anyway, in that case, they would be betting on the sponsor rather than the actual company going public, which holds its own set of risks. The average share price for a completed SPAC in 2020 to 2021 clocked in at just $8.70, a 13% decline from the average $10 starting price, despite the stock market as a whole finishing 2021 pretty strong. So while there was a lot of institutional investment interest for SPACs, you also had retail investors fueled by a meme stock era hubris that didn't exactly know how to look at these companies and be like, these fundamentals actually don't match up with the price I'm paying. And sure enough, things did not go quite according to plan. Much like all those cars Oprah gave away and then people ended up having to pay thousands of dollars of tax on, it did not take long for people to realize that maybe SPACs weren't the golden ticket to riches they thought they were. Indeed, around this time, the chair of the House Financial Services Committee expressed concern that SPAC mergers are structured to ensure Wall Street insiders receive huge profits and retail investors pay the cost. While SEC Chief Gary Gensler noted from the sidelines the common trend of the retail public bearing much of the costs involved in various stages of capital raising in a SPAC's life cycle. Enough was enough. Regulators did what they do best. They started creating new legislation. So around March, April of 2021, the SEC, which regulates SPACs, started to pull the wool out from over retailers' eyes, first releasing a notice warning people to not get involved in SPACs just because a celebrity was endorsing it. Seems pretty sensible advice, but the fact that it needed to be said at all really reflected the mood at the time. So SPACs was a massive bubble and nothing good came from it. No, not quite. Actually, there were some success stories. Some SPACs actually bucked the trends of decline. But who were they and how did they do it? Well, after taking a deep dive into the 2020 SPACs, where they're trading at now, their recent news, and their fundamentals, we have found out a few things. And thank goodness too, because it took forever and definitely gave me a couple more grey hairs. Let's take a look. With all of that in mind, we would like to introduce to you the best performing SPAC of 2020. This company is up a whopping 195% since listing on the market and hit a brand new all-time high in April. And its name is, drumroll please.
Drumroll please.
High Peak Energy. Yep, you can see why this oil and gas production company would be the top dog of the year so far, trading at around $22 after entering the market at just under $9. If we take a hot sec to think about 2022 as it stands now, you see flashing images of sky-high energy prices, oil topping the charts, the Ukraine war grabbing the world by the balls and squeezing super hard. And you can see, when you think of it like that, why High Peak has topped the SPAC charts for the year. MP Materials is another of our 2020 winners with 104% gain since going public, and it has similarly been enjoying an industry-related bump. It's a mining company that produces a specific rare earth material that's super key to tech and EV products, which are in high demand right now thanks to a supply crunch and an EV push in the US, hence the gains. It's not rocket science, but it's abundantly clear that the industry in which the SPAC sits is endlessly important to its performance. In case you wanted to see, here's a little chart of the industries that 2020 SPACs were in, largely dominated by tech and healthcare. Though that's not to say that the business itself plays no role. On the flip side of things, industry can equally work against you. Let's press F in the chat for our worst 2020 SPAC performance, Metin Education. This Chinese education company has lost just about 100% of its value since hitting the market. And when you remember that China outright banned for-profit tutoring services for core school subjects last year, it's clear that this is hardly an industry with promising returns right now. If you take a look at any of our worst performing companies, nearly all of them have seen some seriously volatile quarterly reporting. Ucommune, as an example, is one of our worst performers with its 91% loss. It is basically the Chinese version of WeWork, which is actually a pretty promising industry to be in right now if you're listening to all the analysts who say that COVID has forever changed the flexible working scene. But if you look at their balance sheet, its revenues are absolutely down in the dumps, and it's burned through 4 billion yuan in the last few years. The right industry alone does not a successful SPAC make. One needs revenue growth to show as well. Now look, obviously this has a couple of caveats sprinkled in. A lot of SPAC mergers are with smaller or growth-focused companies, or companies that might not even have a product yet. Many SPACs chose that route to market and drew in investors because they could be classified as growth stocks. The idea being, get in now and hold your hat until future revenues start materializing, basically. However, we also know, I hope by now, that we are deep in a bear market at the moment, and in a downturn like that, growth stocks are most susceptible to falling because they're richly valued on future profits, with people instead flocking to the perceived safety of more established companies. Appetite for these speculative early-stage growth names with little earnings has severely diminished in the face of rising rates, as well as elevated market volatility and the worst economic uncertainty in over a decade. What you'll also notice about these successful SPACs is that they kind of go against the growth stock grain of normal blank checks. So, how do you invest in a company that has no revenue and no product? And how do you know if that investment's actually going well? Well, now we're going to get down to our wild cards. Cerevel Therapeutics is a biotech company that focuses on neurological diseases. It's one of our best performing SPACs of the year, and its shares are up 176% since they started trading. But its revenue is sitting at exactly $0. We know, WTF. Well, it turns out that Cerevel is making big moves in the treatment of schizophrenia, and their clinical trials are passing with flying colors at nearly every single stage. The company is also a spin-off of Pfizer, which has become a household name since COVID, so that partnership is also going to boost sentiment around whether the company will be a success. Having no product can work out in the long run if the company is able to keep up with its own lofty predictions and has regular news about the success of those predictions. Obviously, again, it works the other way around, as we can see with Nikola, the EV brand whose shares are down over 85% since execs got in hot water with the DOJ for selling false promises to investors about the amount of orders it had on the books. So, just like any traditional IPO, industry revenue and news all play a part in the performance of a SPAC once it's merged. But because of how much more accessible SPACs are, their books have not been through the same intense scrutiny, so there's potentially less confidence in the business, and they decline more rapidly when things like industry revenue and news are absent. Go figure. Okay, so what now? Where do we stand with this ready to burst / already burst bubble? In March of this year, the SEC released its first real set of proposed rules to govern SPACs, the aim of which was to ensure that blank check mergers and those involved in them get more scrutiny and tighter oversight, requiring more disclosures about possible conflicts of interest and giving more responsibility to those banks underwriting these transactions. Since then, regulators have seriously started upping their focus on SPAC regulation, investigating the promises made by companies going public and their execs, and taking action against companies like Nikola for making fraudulent claims. Share prices have started dipping and underperforming the market, people are losing more money, and the pace of the SPAC IPO market is easing substantially during the second half of the year. These changes made to SPAC warrants that paused the market and caused many SPACs to restate their financial statements, as well as a general glut of SPAC IPOs that exceeded aftermarket demand, leading share prices to trade down after the IPO. As a result of all of this unwanted attention, companies like Goldman Sachs have pulled out most work on SPACs, and Bank of America has ended relationships with some of the vehicles it was working with. That's only to name a few of some of the impacts of the proposed legislation. Added to that, the new rules would make it easier for investors to sue companies over false predictions that don't come true. So suddenly, this new trend is looking less and less appealing to everyone involved. It may not be necessary to press F in the SPAC chat just yet, but it's now mid-2022 and everyone is looking at their SPAC holdings and thinking, shit. This year, over 30 special purpose acquisition company tie-ups have been called off. Lawsuits are hounding those that managed to get through in the last couple of years, and regulators are doing their damnedest to find a reason to trip up soon-to-be mergers. Backers are getting desperate, which might also mean that they become less prudent in picking their targets, which could just make everything a whole lot worse. It could also take up to 2.5 years for inflation to cool, and in the meantime, the road for growth stocks looks bumpy ahead. If existing SPAC mergers are able to stay alive that long, and with a little bit of guidance from the SEC, it's possible that the market will have a chance of redemption, though it's unlikely it will be anywhere near the levels we've seen in the last few years. You know what they say about too much of a good thing? It can turn very bad very quickly. Please let us know in the comments below what you thought about this video and if there are any other topics you'd like to hear about, because we love hearing from you. And until next time, whatever you're doing in this market mayhem, always remember to look first and then leap.